NCI portion will get that 20%. So they get 600. The other 2,400 that makes up that 3,000 belongs to the parent, as well as, remember from our schedule, the 5,600 that was fully the parent. So the parent has 8,000 there, and therefore the entry to cost of goods sold here is 8,600. Now the current sales that are being eliminated, we go back to the text, we see there was 60 that was sold by the parent, 30 by the sub, so a total of 90,000 is our IS entry. And then for our EI entry, we can go back to the above table and we see that we have 42 and 48. This is not yet closed to retained earnings, so we don't have to split it out yet between parent and sub, because the sub NCI portion will be split out in the IDS, the income distribution. So for now we can just combine these. So 48 plus 42 gives us a total of 9,000, and the 9,000 we're going to bring down here then to our EI entry, and that takes care of that one. Our IA entry is simply given in the text. It has to do with amounts that are still owed between the parties at 14,000. Then we're down to our second set of intercompany transactions related to the fixed asset, intercompany fixed asset sales. So these entries are all related to inventory and what we did in exercise 4.1. These are related to intercompany sales of fixed assets, which we did in exercise 5. Now you'll notice for the F1 entry, I put a couple of different lines here just so it'll be easier to follow. You could easily combine it though into one entry. There were two different items, remember, back up in our schedule that we did for intercompany fixed assets, the 40,000 and the 24 profit, and that's why I've split them down below, because we're going to use those two factors. So the 40 had a prior year item, so we take the 40,000 out of the equipment, because that, just like in exercise 5, that was the total deferral. 5,000 of that was already adjusted in accumulated depreciation, and the 35 then is our retained earnings portion. For the other one, we saw in our schedule up above that the total gain was 24, and that gain happened this year, so it's still a gain on the books. It hasn't been closed to retained earnings, so that's our amount there. Then both of these have to be depreciated, we saw over time, and if we look at the depreciation, the total amount that we're concerned about is the sum of the two, or 9,000. So the 9,000 can just come into our F2 entry as a combination down below. So that should take care of all of our entries. Now it's a matter of putting them into our worksheet. And I'm going to take a brief break from recording as I do these so you don't have to spend time watching me load them, and I'll show you the finished product after they're loaded. Alright, as you can see, I've loaded all of the entries, just posting them like you would post to a general ledger, posting the debits and credits, and again, like I did in chapter 3, putting the credits in as negative amounts so the worksheet math is a little smoother. And my total debits and credits equal at 664.8. Now we'll pick it up there and go ahead and complete the worksheet, and I'll demonstrate the rest of the completion of the worksheet. So again, like I did in the prior chapter, all of my assets and liabilities just get carried across to the consolidated balance sheet. So we'll go ahead and carry those all across. Remember, there are a few items we need to make adjustments for. First one being the investment account, because the investment account, just going straight across, we've missed a couple of adjusting entries. So we'll go ahead and pick those up and adjust for the fact that we picked those up. Our other one we need to adjust for here is, you'll notice the equipment, we actually spilled over into another line for the adjustments. So I'm going to put that on its correct line. Our accumulated depreciation, the same thing. We've got multiple lines. We need to pick that up. and eliminate that. We are good till that point in time. Then we get to the equity of the subsidiary, and we know that any equity related to the subsidiary belongs to the NCI. Whatever the parent doesn't own belongs to the NCI. So we're going to carry those balances across. Again, though, I need to adjust this retained earnings figure for the fact that we've got two adjustments that couldn't all fit on that line. So there's our NCI amounts. Then we're down to our parent equity. We'll carry across the stock and paid-in capital directly to the consolidated balance sheet, but the retained earnings amount will carry across to the controlling retained earnings column, and again we will adjust the formula to pick up the lines that we did not pick up just going one line across. So that takes care of all of our balance sheet items. Now we're down to the income statement, and on the income statement we can carry across all of these items to the income statement column. And again, we'll need to make a couple of adjustments here. Our sales should be fine. Our cost of goods sold, we see we have, again, one too many adjustments in the line below. So we'll adjust for that. Our depreciations are fine. Other expenses, interest, and notice that our gain is now eliminated. Subsidiary income is also eliminated, and we're down to dividends. Well, this line item right here is related to the NCI again, which goes into that column, and the dividends that were declared by the parent, just like in financial accounting, become part of their retained earnings. So we now have completed it down to our initial subtotals, just like we did in Chapter 3, and we see that the combined income at this point is $154,100. So let's bring that $154,100 up here as a checked figure to the side, and we'll use the income distribution again to allocate that between the parent and the NCI. So starting with the subsidiary, I'm going to go ahead and get their internally generated items right from their trial balance. So their internally generated amount is $29,500, and let's do the same thing for the parent. Going to the parent's trial balance accounts for the income statement gives us internally generated income of $155,000. So those are our starting points. Then you'll see that as we look down below, we need to adjust for, remember, everything that happened in this income statement area that is not part of either general ledger. So I need to account for basically everything that I've highlighted there. Now remember, the IS I don't have to account for, so we can eliminate those two. But we need this EI, the BI, the A's, the F2, and the F1. We need to account for all of those. So let's start up with the EI. Well, the EI, remember, was partly for both parties. 4,200 of that relates to the parent and 48 to the sub. So we're going to put in here ending inventory. You can use the same categories if you want, or same references as our other entries. And we're going to put the 48 for the sub and 4,200 for the parent from our schedule that we did up above. Okay, then let's go back down here and we can highlight our amounts again. So we've got the EI. Now I need the BI entry. And the same thing, I can go up to my detail here with my BI, my beginning amounts. Our 3,000 is eliminated for the sub, and you see the 5,600 for the parent. Now if I go back down here again and highlight my same things, okay, I've done the IS, EI, BI. Now I'm down to my A's. Well, we know A's are amortization of excesses. Those all belong to the subsidiary because the subsidiary, it was their excesses. So we're going to put all my A's there. Again, if I go back down here, pick up the right items, I've got my F2 and my F1 left. Okay, so my F2 was from this little schedule that we did here. So 5,000 of that was the parent, as we saw in that schedule, and 4,000 was the sub. So that's where those two come from. And then the only one I have left is my F1, which the F1 is related to the gain in the current year, and that gain was the sub. So we'll put these together again, I guess. Save line items here. So I'll put my 24 there, and now we've accounted for everything. Now we can do our totals again. So my total for the subsidiary, and I'm going to go back and put these in as credits like I should have done to begin with. So the total profit I need to allocate for the sub is 7,300. For the parent, I have to bring down my controlling interest from the sub before I can finish that calculation. So my 7,300, 20% of that is the NCI, and the other portion belongs to the parent, so that 5,840 is coming down to my parent's distribution as a loss, because it is a loss. You'll notice that the way our entries ended up there, it actually ended in a loss position. So there's my controlling interest. And again, I'll do the math here then. And my controlling interest is 155.56. Well, I know I've got a proof out to that 154.1, so let's see if this works. There's my controlling or consolidated amount combined with my NCI portion. There's my 154.1, which agrees with the amount up above, and therefore I've reconciled between those two. Now I can use this 14.6 and the 155.560 to allocate my amounts on the worksheet down below. So just like we did in the prior one, we're going to take the 1460 out of there and allocate it to the NCI, and then our controlling portion of the 155.560 we're going to allocate to the parents' retained earnings. And let's get our footing happening for the very bottom here. So we take from our subtotal through to the bottom, carry those across. There we go. Alright, so I've allocated out my income like I would in a year. I'd allocate it to retained earnings. In this case of a consolidation, we allocated to the NCI and the parent. My ending NCI balance is 84,340. So I'm going to take that and close it to the consolidated worksheet or consolidated balance sheet, because it's going to become part of that equity reporting on the consolidated financial statements. And my ending retained earnings, just like I do in basic financial accounting, gets brought over to the balance sheet, and my balance sheet now foots to 0, and here would be my reporting.